everyone, and welcome to my masterclass on machine learning and investing. If you like the content of my channel, make sure to subscribe and get notifications for new video releases. As a preface, as I said in the description for the event, this will be an intermediary event, so it will sort of assume that you know the basics of investing and that you know the basics of machine learning. And we'll be talking more about perhaps how you could combine those two in your portfolio management. As always with my webinars, if you have any questions related to what I'm discussing, please pop them in the Q&A section. I'll either pick them up, I'll keep an eye out, I'll pick them up as I go along and try and make this a little bit interactive. Yeah, or there will be time for questions and answers at the end. So I'll have to start by saying that this event is for educational purposes only. None of this is financial advice or a recommendation for your own investing. I'm sure a lot of you know me from eToro. You'll know that I use machine learning as part of my portfolio management. I won't be giving away any trade secrets tonight. I have been in machine learning for a decade now, so this is sort of all of that. I tried to cram that into an hour. The idea of this evening is that by offloading as much of that information that I have collected over a decade onto this webinar, that you would at least know what are the right questions to ask. I'll give some resources for places where you can begin if you haven't, and hopefully go through a bit more advanced things for those who have tried their hand at it and would want to really get stuck into it. As you know, I have a background in machine learning, but I'm also one of eToro's most copied popular investors. Over the last 5-7 years, I have had over 20,000 people copy me with more than $50 million in assets. I've recently become a full-time popular investor, but before that, I was an AI research fellow at the University of Oxford, where I still continue to be a visiting fellow. And just some brief introduction about myself. I came to Oxford as a Rhodes Scholar. I did an MSc in biomedical engineering and an MBA. Before that, I was studying in South Africa, where I'm originally from. And I then later did my PhD, or DPhil as they call it, at Oxford in machine learning, where I hold 2 patents and a number of publications related to my work, specifically in novelty detection and failure prediction. And I'll talk a bit about how that journey has helped me in my investing and vice versa, because I've been doing this simultaneously for a long time. I also now do public speaking events and try and disseminate as much as what I have learned over the last decade about investing to as many people as possible, so that you don't have to take that long to get to this point in your journey. So that brings us to the content for this evening, or wherever you are for this webinar. So I'll be looking at some machine learning based investment strategies. We'll be looking a lot beyond just price prediction, because I think that's the one most people assume is used in machine learning. And then I'll be looking at what does it mean for your portfolio construction and your investment management, and then just touching on some of the risks that are associated when you begin to mix machine learning or AI more broadly with investing. So how do scientists use machine learning? Well, most obvious answer usually is it's this magic bullet prediction machine. It's the golden bullet that will give us all the answers. It's the oracle. It's a black box that you feed data and it spits out the answer on the other side, or you just turn this crank and it spits out the answer. Without stepping on anybody's toes, and I'm sure there are some machine learning experts perhaps in the room as well, but that is certainly a school of thought. It's not one that I specifically subscribe to. In fact, I'm very cautious when I speak about machine learning. So if you know electronics, this is a NOT gate. So to me, machine learning is not oracle. It's not a black box. The more we can understand about the box, the more we can understand about the algorithms we're using, the more we can ask better questions, the more we can make sure that we feed the correct data. And so I really see it more as a decision support system in my toolbox that allows me two things. The first thing is really just it allows me speed. It allows me to reduce the analysis time that is required to do the suitable analysis to come to a decision, and it also allows us to take into account data arrays, their volumes, the structures of the data, and other metadata, perhaps of complexity and scale that wouldn't be necessarily possible for a single person to do. But then the second thing that it allows us to do is this decision support system allows you to make to improve the confidence interval of your accuracy for your predictions or your outputs. So that's really the two things that I try and achieve whenever I use machine learning. I have worked in healthcare, I've worked in solar, I've worked in credit scoring, I obviously have worked extensively in stock markets, economic prediction. So, and across all those fields, I always try and remind myself that it is just a decision support system. I need to approach it as such, and that allows me to really optimize it to its maximum rather than stepping in some of the pitfalls that is associated with it. So if it's not the black box, if it's not the oracle that we have been promised it will be, then what is machine learning? What is AI? What is deep learning, reinforcement learning? And how do scientists, specifically my time as a research fellow at Oxford University, how do we approach it? How do we use it? And how do we think of it? Well, I've sort of broken it into 5 main things, and I'll go through each of them. The first one is using machine learning to evaluate the plausibility of theories, basically to prove existence of something. And this is perhaps beyond the scope of this presentation, but just to give you a flavor of what it can be used for, specifically in the mathematical fields where algorithms are often used to help make discoveries. So it's not able to prove the theory or prove the path, but if we are able to predict something, we know that it exists, and mathematicians can then use that to go off and do their evaluations and uncover the mechanism by which these predictions exist. So that there have been many cases, especially in maths, where it's been used to prove existence of something. The second thing that also relates to more specifically to financial machine learning is importance. So we can use machine learning algorithms to determine the relative informational content of explanatory variables, what we typically refer to in machine learning as the features, and use those for predictive purposes. So a very good example would be if we're using, for example, the mean decrease accuracy. So every time we set up our particular data set and derive the cross-validated accuracy, we then rearrange the data set and determine the accuracy again. And any changes in those accuracy can tell us the importance of weight that we give to certain features. And that can be important as a stepping stone to get to the model that you want. So you're determining which of the features are contributing the most information to explain the data set. Because sometimes there's overlap in certain features, so you don't want to use all of them, or you just want to simplify it. So yeah, it can be used to just help you prioritize your features and see the importance of those features. The third thing we use it for is to evaluate causal inference in specific data. So if we fit a machine learning algorithm on historical data and predict the outcomes, we can see whether there is some absence of an effect. This is often purely driven by just the data, so in an oracle type of fashion. But if we then collect the observations of those outcomes under the presence of that specific effect, we could use the error between those different variations to see whether there's any causation in the proposed data set. So yeah, that's the one cause and effect sort of approach that we could use. Of course, there's the whole debate around causality and causation. So yeah, that's one approach. The fourth approach, which is fairly useful for economic and financial data, is just really reducing down the data. That could be either through the visualization of really large and high-dimensional complex data sets. For example, if you can cluster your data together from a large number of observations to reduce them to subsets of different peer groups. You can begin to investigate the different properties. From a personal project that I have worked on, my data, this was in frequency, it was vibration data, so it was 128 dimensions of data. Of course, where do you start with that? As humans, we don't even know how to sort of visualize that. And so a reductionist approach was a really helpful first step to perhaps get that data down to 3D so that we can actually visualize it to something that's sort of understandable to the human eye and the human brain. So yeah, just simplifying down really large, complex data sets is an important approach of machine learning, and specifically in economic and financial data, because there's just so much data that we're able to use. And then the fifth thing is the retriever approach. And that's really, I think, what everybody sort of knows, the wide application of machine learning. And that's when you go through big data sets and you search for patterns that humans typically fail just because of the complexity or the scale or the multidimensionality of the data. They're not able to sort of, a single human is not able to pick that up. Communication between a large team might fail to pick that up. And so often in cases, machine learning can pick up those large data sets that are just either too computationally intensive or too expensive for humans to process. A good example is you might hear when supernovas are detected. So that's usually every night there'll be cameras or satellites taking pictures of the sky. There are algorithms on supercomputers processing these, and they would sort of identify any supernovas that cross through the night sky. So that's a good example of when machine learning can detect large patterns or events based on the data where, yeah, it's just too large or complex for us to find. Assuming you all have a basic understanding of machine learning, I will just go through main steps of machine learning. Hopefully it's all familiar to you, but the reason I think it's important is if we're talking about financial machine learning beyond just price prediction of the stock, it's important to understand in which of these steps can we apply to our data. So the first step would be to collect data. Very often, as a retail investor, you may not be collecting firsthand the data. You might use publicly available data set on the stock price, or you might use something like StockTwits if you're doing NLP for your sentiment analysis. So we're not necessarily always collecting the data firsthand, although if you're doing some scraping, you could probably put that in that cluster. But yeah, the first thing is to just have a think about what you want to do and sort of get your data together. The next step is to prepare your data. As I said, there's an old saying, garbage in, garbage out. It's so true with machine learning. If you're going to feed it a bunch of nonsense data, or if you're feeding it data that is highly overlapping, any additional data that you give might not be adding enough new information for the machine learning algorithm to explain the data set proficiently. So preparing your data, looking for outliers, and just generally getting it into a format where you can use it, whatever you're using. If you're using Jupyter Notebook, Python, whatever you're using, getting it sort of into a format that you can use, cleaning it out, and getting ready to sort of dig in. Part of preparing the data also obviously includes visualization, although some people put it into step 3. So that would be where you're sort of trying to think about the type of data that you have. Maybe you compare a bunch of different models to make sure to see which one is more suitable for your application, for your data set, for what you're trying to predict or what your output is specifically. So that would be choosing your data. Then, of course, you're training your data based on the size of your data set and the complexity of your model. This could be a few seconds up to, if you're getting into deep learning, depending on your processing power. I've had to leave some of mine off and leave them overnight. Fingers crossed, nothing fails and you have a successful morning. So yeah, that's just training your data and comparing accuracy. So evaluating the model. Is it suitable for the application that you're trying to do? If you're trying to classify something, there's no real point in using like a regressive model or vice versa, but sometimes it does. Sometimes you can't necessarily classify something into very distinct classes, but you sort of have to do regression and then force them into those classes with a sort of 8th step. So yeah, just evaluating whether the approach that you're using is fit for purpose. And this is sort of where I sway away from the black box, because I think if you think of machine learning or AI as a black box, you really struggle with this step. You'll struggle to evaluate and interpret what the model is doing, and you'll either be very lucky and have something that works but it's not reproducible, or you'll be quote unquote cheating. That's often when, we leave some of our test data in our training set, perhaps intentional, perhaps accidental, whatever the case might be. You get a really good output. You think your model's great, which is fine when you're just playing around or doing research. But when you're actually, working with money and investments and decisions that have a real consequence, whether it's life or death or profit or loss, you want to make sure that you're almost throwing everything at your model when you're evaluating it to get the worst possible performance, so that your worst case scenario when you're going into your real world situation. Then you tune your parameters based on how many. You might have some hyperparameters that you have to tune. So you just sort of go over this process to make sure that the model that you've picked is now being optimized for the type of data that you have in your training set. And then finally, you predict whatever you want on your test set, on your incoming data. If you're doing it real time, whatever it is you have, you sort of predict. And it's important to remember that our ultimate goal when we are choosing that first model is we want to use it to be able to classify or predict any new examples that we're getting. So the algorithm really sort of defines what shape the data is in. So if you're classifying it, perhaps you're sort of drawing boundaries around your data. But if you're predicting, more often you're sort of trying to get a model that is well fitted to your data, that explains the shape of the data, because that would make it robust for any new data coming in. But you also don't want it to overfit. And that's one of the dangers we will be talking about. But yeah, you really just want to get the shape to fit as close as possible to the data that you have. And that's why it's important to make sure that you prepare your data really well. So that brings us, that's an overview of general machine learning. That is true for probably most applications that you are doing. So if we come to financial machine learning specifically, I often get the question that financial machine learning or investment machine learning, whatever you want to call it, I don't think there's a fixed term for it. It's so like new and developing. It's basically all about price prediction, right? That's usually the assumption that I get. And that's probably one of the greatest misunderstandings. Like people often ask me, can you direct me to a machine learning model that can help me tell when to sell, but helps me to tell when to buy? And those are great. Those are the sort of obvious use cases. I'm going to be trying to expand a bit on a lot of the other applications that you may not have even thought about for using machine learning in your investing. And that's because asset pricing is undoubtedly a really valuable endeavor for any investor, and the importance of it can't be overstated in investing. But just having an edge on price prediction isn't necessarily gonna be sufficient in a very competitive market like we have to make sure that you're successful. And that's why I want to talk about everything else that machine learning can do, so that you can think about some of the other equally important application, whether it is data processing, whether it is portfolio construction or risk management, or monitoring of structural breaks, or bet sizing, or detecting false investment strategies. So those are just a few examples to sort of let your mind go a little bit about what are some of the other applications that we will be talking about. And a really good example I love for this is if we think about the World Series of Poker. As you know, a lot of kind of people in machine learning often have played poker or have passed through that world or have tried to apply machine learning in that world. And in poker, the cards are shuffled and distributed randomly, and the players obviously can't predict the cards that will be handed to them with any sort of meaningful accuracy to have a competitive edge. And that's really what we're trying to do when we're applying machine learning. We want to have a competitive edge over the market, over our benchmark. We're really trying to get that edge. And despite, you know, players trying to predict the next card in these big poker tournaments, you sort of see the same players every year ending up in the top spot year after year. The same players sort of make it. And that's because of all the other aspects that are important in being successful. That is bet sizing. So, you know, you might be able to know what card comes next, but you can't just go all in every time, because there might be a small chance that you're wrong. And so when a player receives a good hand, they have to evaluate the probability that another player might have a stronger hand. And in the same way, investors have to do the same when they are predicting prices. So they have to recognize out of normal prices. You might be predicting here that the price is going to continue going up, and actually if something happens and it drops, then that was your best price. It's just stating that price prediction is not the most important factor when we are talking about investing. So what are some of the strategies and algorithms that are then important? So I've sort of clumped them all together, but I will try and elaborate on each of them. And if there are any questions, I am keeping an eye on the chat. There are the main section, which is the stock prediction models. And I've sort of tried to, if you sort of flip this over, you can think of almost hopefully the sort of buckets that would be there in traditional investing. And I'll talk later about the things which we can do with machine learning, which we could never do before. So we've always tried to predict stock prices. We'll talk about deep learning and machine learning methods that are being used for that specifically. So that might be forecasting the price, or more specifically trying to get buy and sell signals, for example. Then there's also the study of overbought and oversold stocks. So that's around trying to time when you buy. And the third one is around sentiment analysis. So here we'll be looking at different sources of data and using natural language processing specifically for analyzing those. Then the second big bucket is around data processing and transformation. Beyond data cleaning, I'll also talk about why outlier detection is really important here. And the third one is around portfolio management. So how do you select and optimize your basket? How do you determine your bet size? How do you analyze your return? So this comes a bit to scenario analysis. And how do you rank scores? So if you have, we have some fundamental analysis ratio, so the PE ratio. Are there sort of scores in machine learning that are not just replicating what we already have, but new scores that add to our decision-making toolbox? And then finally, risk analysis and factor analysis. So the one I'll spend a little bit more time on, which I assume most of you are here for, is the stock prediction models, because it is sort of the one I think that a lot of people struggle the most with. The question I get a lot is when I ask people, why do you want to use machine learning to predict prices or to predict stock market movements? It's often not, the answer I get surprisingly is not that, oh, I want to have an edge, I want to maximize my profit. The answer I get most often is actually, I want to reduce the emotion involved with making that decision. And that's the exact same reason why I started using machine learning, because I wanted to have as much information as possible to sort of calm myself and reassure myself that the decision I'm making is based on more quantitative assessments rather than intuition or qualitative assessments, which are also important in investing, but often tend to develop over time as you are more accustomed, more comfortable, and more experienced. You tend to sort of, I have found at least, tend to like feel more comfortable with those. So the most frequently used is deep learning. Deep learning, machine learning, these are becoming more and more sort of like intertwined. I should really be saying AI, but deep learning is really just a broader family of machine learning methods that are based on the artificial neural networks with representation learning. So that is LSTMs, GRUs, CNNs, for example. So I've given a great GitHub repository here. It's not mine, but it's one of the most popular ones on GitHub. So if you want to have a little play, they've got a bunch of sort of ready-made models, as well as some of the results for the dummy data sets that they give. So you can have a play around that. I think it's in Jupyter Notebook. So you can have a play with that. But the main objective there is around predicting buy and sell signals. So it's a really useful, good starting point. But the second thing that they look at is, or that's also quite commonly used, is reinforcement learning. So if you are familiar with reinforcement learning, that is an area of machine learning where we use what we call intelligent agents, or just agents for short, who take an action based on their environment to maximize, in this case, your return, and they have a reward. So there's a reward function. It's very similar to the sort of teacher-student learning process where you do something, you either get a positive reward, or based on the size of the reward, you learn that next time that's a good or a bad thing to do. So that's sort of where AI is becoming more human-like in its learning process. Both deep learning and reinforcement learning have become quite popular because, unlike, the sort of traditional machine learning methods, which tend to be supervised methods, these are unsupervised, which means you don't need a lot of labeled data for your predictions. So here's just an example output of using LSTMs versus convolutional neural networks, which are both deep learning approaches for forecasting different stock prices and then comparing them to the true trend. So obviously this is all backtesting, it's all done with previous data, and you can sort of pick which one is the most accurate for the data or the specific stock or the sector that you have, and then try and apply that for forecasting into the future. Of course, forecasting is always difficult with machine learning, and the further we try to forecast into the future, the bigger our sort of range for variance becomes. This is an example just to give you an idea of how the reinforcement learning agents work. So this is on the top here, we have something called the evolution strategy agent. So that's a type of agent. And then at the bottom, there's the policy gradient agent. And they then compare the buying and selling signals retrospectively for that stock price. And in this case, for this example, the agent was only allowed to buy one unit. So if they got a buy signal or sell signal, they could only buy one at a time. So there wasn't the additional question about bet sizing. So this was a way to control some of the factors in order to compare like for like. It was the same stock. You can see that they have different buy and sell signals depending on the agent that you used. And then also the total investment at the end was different. So the evolution strategy grew the investment by 39% and the policy gradient by 7.9%. So of course, that doesn't mean the evolution strategy agent is the best, but in this case, it did outperform a lot of the other methods. And if you go onto the GitHub, you can see a comparison of a lot of the agents, just to give you a flavor or an idea of a type of application that you might choose. The second approach is to do an overbought, oversold study. This is an example of Tesla stock, again, by the same GitHub repository. And you can get it on eToro as well, where you can put the RSI, so you can see how many people are buying and selling stock. And this is a sort of approach on that, where the idea is the good old supply and demand. So if a lot of people are buying or a lot of people are selling, you can anticipate the future impact of that on the stock price. So that's the idea with overbought and oversold studies. Then the next one is sentiment analysis. That's one that I've been quoted for in the Bloomberg for using as an additional data point that we didn't have before. So I really love the eToro social feed for this. But of course, there are a wide variety, and some of them now sort of come automated. So this screenshot here of positive sentiment, I took it off eToro's own analysis sheet. I think they give it for most of the stocks. They base it on how many hedge funds are buying or selling. So it's fairly kind of, I think, binary sentiment analysis. I'm not really sure how they do this, but yeah, it's just an example of a type of sentiment analysis. But yeah, the three sort of main ones that you can consider using if you are familiar with natural language processing is firstly is just analyzing text data from news sources, because that sort of allows an individual investor like me to scan through a lot of different news sources without needing a large team to do it, because I can just get an algorithm to do it. And that's not to say that I leave it as an automated process, but it does sort of flag things to me that I need to look at a bit more closely. And so that allows a single investor like myself to sort of get through a lot more than I would be able to. An important thing with sentiment analysis is the sort of time frame that we look at that sentiment over. So you could look at the last 7 days, you could look at the last 30 days. There's sort of a really large scope. You could look at the last year, but it's kind of 7 and 30 days are kind of good time frames to look at, depending on what your kind of analysis you're trying to do. The second one is social sentiment. So that's becoming more and more an important source for traders and investors. And that really analyzes the vast amount of text data that's available on social platforms. So I think the most sort of freely accessible data source for this is stock tweets, which a lot of people use. And here is just an example of an app called MLQ.ai, where they have done a positive, negative sentiment analysis of a particular stock. Usually there's a third one, there's a neutral sentiment. And again, that can sort of just help guide a single investor and give them a broad overview of what's going on in the broader market. So some of these are available as plug and play. As I said, there's this app called MLQ.ai. I don't know if you have to pay for it. I haven't personally used it. eToro is giving some of the sentiment analysis for free. But then the sort of third one, which I haven't seen a plug and play version for, but that I use a lot, is SEC filing. So that's arguably one of the most valuable applications for me when I'm doing my analysis for investing. And that's just as a single analyst, if you're interested in analyzing quarterly or annual reports from companies, you can do a large sector, for example, and it could take a single person weeks or months to read through. But with the help of natural language processing and certain algorithms, you can speed up that whole research process by quickly reviewing those. And again, the same with the news, you sort of just highlight ones which have interesting information that you should take a closer look at. The second bucket is the data processing and transformation. Of course, as I said, data cleaning is really important, especially because we're often dependent on third-party data. We're not collecting the data ourselves. So we really have to make sure that we know what's in that data set, that there's not a bunch of junk in there, and that it's not going to mislead or, skew our data set when we are trying to train our model. The second one, which is really important for me personally, which can either be a final output or a stepping stone, as I said, is outlier detection. So as I mentioned, I did a lot of work on novelty detection, where I had built algorithms to predict failure of certain mechanical machines. We used these algorithms on Boeing aircraft engines, on hand pumps, and the idea was that even though these failures are sort of outlier events, they're really important to predict, because if we can learn a sort of repetitive pattern leading up to those failures, we can try and do preventative maintenance or something of the sort to reduce the downtime of the system. And the same with stock markets. They're a lot more difficult because often the outliers are black swan events. There is a lot more sort of human interaction and human emotion involved in this. So they're not always logical, and black swan events are just that. They're not often, predictable or reproducible. But some of the outliers are explainable and are sometimes predictable, even though they are outliers. So that's one kind of application of outlier detection, is where you're actually using it to try and preempt the outlier coming. So one is for the data cleaning. You want to obviously clean out the outliers because they can skew your data. But the second thing is, if you actually flip it around and say that rather than discarding the outliers, do I actually take an interest in the outliers? Because when it comes to investing, the outliers are often the ones which gives me the competitive advantage. And if I'm able to detect or predict or foresee an outlier, I'm able to act sooner. I'm either able to buy or sell a stock based on my hunch or my prediction of a certain outlier. So that's where I've bucketed it under data processing, because that's sort of where it's usually put. It's a stepping stone towards your final model training. But sometimes it can become a very essential part of what you're trying to achieve. And yeah, that's just one example of how I think it can be used. The third bucket is thinking a bit more broadly about so we're zooming out from the individual stock to your portfolio, and that's around portfolio management and portfolio construction, to make sure that you're selecting and optimizing the stocks that you have in your portfolio. So one thing, the second most question after when do I buy, when do I sell a stock, I think the thing people miss the most is, what is your bet size? How much of that stock do you need to buy? So yeah, sure, I know that's a good price for a stock. I know if it hits that price because of whatever analysis I've done, it's a good price to buy at. But how much of it should I buy? How do I know how much to buy? Is it, yeah, so that's sort of where you can use bet sizing and use machine learning specifically for bet sizing, where you can do a little bit more forecasting to see how will adding a certain amount of stocks into your portfolio and then forecasting the price changes in that portfolio kind of change or skew your portfolio into the future. And the second thing is return analysis, and that comes a bit more to scenario planning. So when the market is very volatile, as it is now, we tend to do a lot of different scenario analysis. So scenario analysis is typically if I buy a certain stock versus not buying it. So what's my trade-off between that? And return analysis can help you make an informed decision about whether a certain scenario fits with your portfolio objectives or not. And so that's just really where you try and estimate the returns with a high degree of accuracy. And instead of sort of doing that as part of your research approach, you can incorporate that into your estimates of, so rather than just relying on what they might be, you can use it for your forecasting as well. The third one is stock ranking scores. So I would sort of equate this to some of the more quantitative factors that we have. Obviously, we have a lot of that in technical analysis, but in fundamental analysis, you'll also have your ratios, which can kind of guide you on some sort of a spectrum. If you're thinking about the PE ratio, that might be something that you use. And the stock ranking scores are something similar, and they're really just used to rank stocks and provide scores based on various factors. And this is the caveat. It really depends on which factors and which signals you include in your, perhaps from your fundamentals, from the pricings, from technical indicators, alternative data. I've had some scenarios where we counted for over 200 factors in our score ranking. And then you can get really creative based on what you're trying to achieve for your portfolio. So it might be that you come up with a score which indicates how well the company is and how well their financial strength is. So you have sort of equivalent, very well established fundamental ratios or technical indicators for that. But can you use the multiplicity of these multiple factors and then apply machine learning to drive a quality score? So what's the ability of the financial market to raise or lower the price of an asset? So those are one of the scores that we have come up with. I've seen the use of some growth scores, so trying to indicate whether a stock is going to grow, a value score, so that would be more applicable if you are doing value investing, so deriving a score whether it is over or undervalued. Momentum score, so if you're looking at whether you know the price of a score of like the buy signal and the sell signal, but often there's some momentum in the movement of the stock price. So you can derive a score for that to see how fast that price is gonna move to where you want it to be. This is a really sort of useful and meaty part for quantitative investors like myself, where you can sort of try and become really creative with the ranking scores and how you use them to signal your investment models. So you then use the principles from fundamental analysis, where your score has a range and your buy signal might be somewhere in that range if it's between 0 and 5. The last one is sort of thinking around factor and risk analysis. So now we've zoomed out from the stock into your portfolio and now probably even further out into the market. So what is your relative versus active risk? Of course, your portfolio has some variance, some standard deviation, but that's also relative to perhaps your benchmark or the market. So what is sort of the broader market doing, not only your portfolio? So here we can perhaps use cluster analysis, for example, to, as an example, maybe identify groups of bonds that behave similarly in thin markets to predict bond liquidity characteristics, which has been really useful over the last year. The second example that I want to give is if you're thinking about risk and return, how much risk are you willing to take for your return? And a really kind of classical application of this is reinforcement learning, because as I explained, it's got that agent, it's got that reward function. So it's a very kind of well-suited approach for a problem like this, because you have your reward function, which you can almost directly equate to your return that you're trying to make. So, and reward your model or your agent's choices based on maximizing a return and hoping that they'll just learn based on that while minimizing the risk that your portfolio has. And then just quickly, sort of those are what I would say is kind of existing applications of analysis, technical analysis, predictive analysis, statistical analysis that machine learning has kind of taken on. Those are the buckets of investment management that has existed. You could sort of draw the lines between them. But then there are also some applications of machine learning which are totally novel, which we couldn't do previously. They're the ones that machine learning are kind of adding to the table. Of course, there are plenty of them, but I'll just give two as an example without overloading you. So the first one would be if you're into cryptocurrencies, but totally I can see this application if as more of the data moves towards blockchain, would be on-chain analysis for cryptocurrencies, but maybe even later for stock prices as more and more of these things are moving onto the blockchain and we have publicly available blockchain data known as on-chain. In this case, some of the trading signals would include new network growth, large transactions. So that's why we're, if you've heard things about like the whales are buying or the whales are selling in crypto or holding, that's because we can see these large transactions and we can analyze them on the blockchain. And then there's just concentration or clustering. We can actually see who's holding on or selling, or movement of assets, money coming in. That's just something that's totally new, which we couldn't do before. It's a lot more opaque with stocks, but hopefully as this is moving onto the blockchain, we can start to do that more for stocks as well, if you don't have crypto as a part of your existing strategy. And the second one, which I've personally used in healthcare, but not needed to use yet in financial ML, is creating synthetic data using GANs. And that's just another interesting application, which might be useful to think about generative adversarial networks or GANs for creating data when you might have data scarcity. So if certain data exists, but you only have access to a small part of public data, and more of the data is becoming behind paywalls, it's either becoming scarce or costly. Could you use GANs to create synthetic data? I've used GANs to create patient data, vital signs, which if you look at it, you would not be able to tell the real patient data from the synthetic data. And of course, also reducing the risk of backtest overfitting. So if your test set is too small, could you kind of buffer that up by creating synthetic data? So that's a lot, and I can keep going, but here are some resources that I've either mentioned or that I think well collated and sort of starting points if you're thinking of using ML in your own investment management. I'll quickly address some of the dark sides or the risks before I take the questions. So the first two, I'm not going to go into them in too much depth, because I think if you've done any machine learning, you'll know the risk of overfitting on your training set. You'll know the risk of overfitting on your test set. As I mentioned, you can use GANs to create synthetic data if that's a problem with the data set that you have. Although if you're just doing stock pricing, so much data is publicly available. I wouldn't see why you would need that. But yeah, that is a real risk. And as I said, people often cheat on those by either leaking their training data into their test set or vice versa, which gives them a good accuracy when they're just doing simulations, which might be fine. But if you're really wanting to apply this to make money, you really want to avoid that. And then the next thing is expectation management, or rather expectation mismanagement, because as I said, AI is not the golden bullet. I know there's a lot of algo trading. I'm not talking against that. I haven't personally used it. I've played around with it. But as I said, I'm in the camp who sort of see machine learning as a decision support system rather than a total automation of the decision making. And so that's why I would be sort of careful around that, especially with investments as well. And the final one is misinformation and scamming. I think that's the largest risk with machine learning, especially related to the financial world. It's just people not understanding what machine learning is, how it can be used, and they're either sold something which isn't really machine learning, it's just in the marketing, or they're just purely scammed. With that, I'll be conscious of time, but thank you so much everybody for attending. There'll be a short feedback form at the end when you leave the webinar. I would encourage you to please fill that in, because it would be helpful in me deciding whether you want more of this content and sort of steering that content. So thank you so much for attending. Thank you so much for your questions, and I look forward to your feedback, and I look forward to seeing you at the next webinar. Bye everyone. If you like the content of my channel, make sure to subscribe and get notifications for new video releases.